Okay, folks, welcome back. This is a weekly review for April 5th, 2019, or week ending April 5th, 2019. In focus, obviously, is our economic calendar and the general commentary for dollar index, euro dollar, GBP, and this week's lesson is going to be on overlay setup. Okay, our economic calendar. For the coming week, we have nothing to speak of really on Monday. On Tuesday, we have FOMC member speaking at 6:45 p.m., not really impactful. Wednesday for GBP during the London Open session, GDP and manufacturing production. And 7:45 a.m., we have main refinancing rate and monetary policy statement for the New York Open. Then 8:30 a.m., we have ECB press conference and dollar CPI and core CPI. And 11:50 a.m. we have a FOMC speaker again, and then 2 p.m. we have FOMC meeting minutes, high impact. So it's going to be rather tricky going into Wednesday's trading. Monday and Tuesday, with the absence of any real economic drivers, we'll probably see the purest price action during those particular days. And then New York Open on Wednesday will probably be very the word escapes me. You don't want to be doing it. It's just simply just, spectate, don't speculate. And then on Thursday, we have OPEC meetings all day, high impact. It's going to be very sensitive and salient for the oil market. And at 8:30 a.m. New York session, PPI for dollar. And 9:30 a.m. and 9:40, we have members speaking again for FOMC. And Friday, 10 a.m., we have preliminary consumer sentiment and Treasury currency report. So that's our economic landmine field ahead of us. Moving on over to the dollar index. This is a daily chart, and we can see that there has been a movement back into our volume imbalance, which we mentioned the last couple weeks now. We do have a liquidity pool resting above these highs here, relative equal highs. That takes us into the 97.80s likely. That looks like it's most likely going to be the upside objective. We had a run below the lows here, big rejection. Order blocks are supporting price. We had a fair value gap in here, traded right down into the middle of that, so consequent encroachment as well for the volume imbalance as well. And it looks as if we'll be looking for upside movement into this week. We had a movement lower here, creating bullish order block. Price trade down into the order block perfectly inside of the candle's body, and showed a up close on Friday as well. So we'll be looking for and have an expectation going into the FOMC on Wednesday that prices should continuously move higher. The FOMC minutes may upset this, so just be mindful of that. I'm only suggesting that we probably see a follow-through on the upside on dollar for Monday and Tuesday. Moving on to the dollar index on an hourly basis, this is that volume imbalance and fair value gap just on an hourly basis. And you can see when there's a fair value gap or volume imbalance, there is inside of it or very close to it an order block. That's what this is here. You can see perfect delivery. Which order block do I trade, Michael? Well, you're in a mentorship now. This is how you determine it. There has to be an element of imbalance or a fair value gap. When they occur, that's the order blocks that you trade off of. When it's in a kill zone as well, it really aids in the accumulation or distribution aspect of price, which we'll talk a little bit about in the teaching session of this video for this week, overlays. Beautiful delivery, and we traded right back up into a bearish order block, back into the volume imbalance, which is the blue shaded area that we talked about on the daily chart. We're keeping everything on our charts as we drop down to lower time frames. This will be talked about in a second, but really nice delivery on Wednesday, Thursday, and Friday for dollar index. Moving into a 15-minute time frame, we can see we have a gap in price here. So there was no delivery of price between this candle's close and this candle's open. So that's all shaded in here, and price was rebalanced to this price point. Then it went up a little bit higher here, went just below the close. So all of this buy side delivery, and then there's a gap of buy side and sell side. There's nothing happening here. So buy side has been offered here. It trades back down, but it leaves a small little gap between this little candle's close. So it has to trade above that to rebalance. It does so here. So now all of this range has been completely filled in on the buy side, but sell side has to be offered to this candle's close. That's this candle right here. You may or may not have this candle on your data, but it's interesting how it goes right to 96.68, which is the open. I'm sorry, the close on this candle here, rebalancing this entire thing. Also, it's the midpoint of the fair value gap between this candle's high and this candle's low. Right in the middle, fair value gap, bam, hits it beautifully. Then and only then does price move higher back up into the volume imbalance relative to the daily chart's upper premium array. So we have really nice signatures and price action that is supporting, in my opinion, higher prices Monday and Tuesday for dollar index. So if we don't see any real movement to the upside and won't see it break down either for dollar, then they'll probably be waiting for the smoke screen for FOMC on Wednesday, and then maybe that's what we'll see, the upside for dollar. Moving on into euro dollar, this is the daily chart. I mentioned everyone got real excited with this up close candle, and they're already looking for all kinds of reasons to look for it to go higher. We've abandoned for the near term that bearish sentiment or seasonal tendency for the dollar index. So even folks that are aware of seasonal tendencies, they're all looking at month number 5 content, and you may not have gotten to that point yet, but they're just looking at that saying, okay, well, it should do this now. And I went through the reasons why I have put it on the back burner for right now, and it may be revisited later on because we have until May. But right now, near term, we're kind of like fading the seasonal tendency on a weaker dollar and allowing it to trade a little bit higher. And then once it blows out those equal highs, then that might be when the seasonal tendency happens for a dollar index, and it may trade aggressively lower once it clears those equal highs on the daily chart. So we also have comparable equal lows on euro, and it certainly looks like it wants to trade down below that into the 111.60s, 111.50s. We'll see what happens if there's any momentum gained below that or up to that point. Right now, it just doesn't look like it has a really nice bullish structure at all. It looks like it's very, very heavy on a interest rate differential basis. Dollar index is still towering over euro. So euro is weaker fundamentally speaking from a macroeconomic standpoint and a macro perspective. There's really nothing bullish about euro dollar. So while it does have a seasonal tendency to trade higher, it's impressive to note that there's just really no willingness to see it do that. And I guess in the long term, macros are really pounding it lower. We had equal highs here on the dollar chart here that had a liquidity pool. We saw that rated on Wednesday, traded through that. We consolidated. Again, I mentioned how that strength in the dollar index is going to be a factor here. And we see a breakdown. I'll talk a little bit more about this area in price action when we do the overlay discussion, lesson portion of this video. But we tried one more time to get above here. Couldn't really do it and traded softer. We have a liquidity pool resting below this low here. If we do get some momentum below that, it'll probably just trade right through this low and just continuously trade lower. I personally feel that if we gain some momentum below 11.50, that we'll see the 110s, and that's what I'm expecting personally for euro dollar. I'm not bullish euro dollar at the moment. There's just simply nothing bullish here in its market structure, and because of the interest rate differential, just everything's against this thing going higher, at least near term. On a 15-minute basis, we can see that we had a fair value gap in here and a bullish order block right at the same time. Which order blocks do I buy, Michael? Well, this is one you can be a buyer at, and you can target liquidity on the upside. What would that look like? Well, we have a run here. We can be a buyer, and this low, this high, this low, right in here, that is a turning point where liquidity is going to be resting right there. So you could target that, and if you're looking at that high, you can start doing measurements of 10, 15 pips, 20 pips above that for a run on liquidity. We see that punch up here. This is non-farm payroll. Don't trade that. But in terms of an example of how to use order blocks and how to trade and find intraday volatility, this is certainly one, and also supports the narrative. I teach fair value gaps with order blocks. That's what confirms your order block. It's not just a down close candle that you buy. It's not an up close candle that you sell. There has to be a fair value gap or an imbalance shown through price inefficiency. Once that occurs, then you do have an order block. Otherwise, it's just a down close candle or an up close candle. GBP, this is our daily chart. Price traded up into the last up close candle here. On Friday, we traded up into it beautifully, hammered it right to the pip, and sold off. Big liquidity pool resting below these relative equal lows, and we have a fair value gap. We have this candle's high, this candle's low, so we'll be looking for price to trade down into there this week for cable. I like that narrative because we had this high here, we traded through it, couldn't rate it higher, traded here, once it rated this high, and once again rated above this old high here, it just gave up the ghost and couldn't find any traction on the upside and traded softer. We have yet to really see a daily market structure break, so it'll be interesting to see once we trade below this low, if we do at all, but I suspect we will Monday or Tuesday. If we get that, it'll be interesting to see what we do. It may come down a little bit into this volume imbalance here and then come back up to it as a breaker. So we might see it revisit the 129.80s before it starts to accelerate and take out the relative equal lows here. And again, that's assuming a lot for a bullish dollar. So near term, again, because of FOMC next Wednesday, I'm looking for price to trade down here and then hit this fair value gap and rebalance. At that time, I'll have to see what we do and how we trade, if at all, back up to this low, which will be a breaker, bearish breaker. Moving on into a hourly chart, we have this up close candle, the bodies, and then we have a higher body right there. This is a bearish breaker. Uh-oh, learning something new, aren't you? Breakers are not always going to be seen with a higher high with the wick relative to a previous high. We look at the volume seen depicted in the bodies of the candles. This is enough. We have a high with the bodies here, traded lower, bodies went higher than the previous swing high, then we broke down. That is a breaker. When price trades back up to this low, which it does here, that's an opportunity to sell. Now, this is non-farm payroll Friday. It's a trade day. I don't do anything with it, but it's interesting also to note that that price point goes right to it, but then it goes 1 or 2 pips more. Why? Because we have a fair value gap. This candle's low to this candle's high. We have one single pass through on this candle. So we have a SIBI, sell side imbalance, buy side inefficiency. Right back to the midpoint, consequent encroachment. Bam. Perfect. Right to the middle of that range between the two blue lines. That's their fair value gap. Precision as you would expect it. Price drops down. We have liquidity resting below this low here. Equal lows relative to Monday's trading and this low here. Relative equal lows there, and 20 pips below that, it's 130.08 is that level, 130.08, or 130.07 I should say, and 20 pips below that would take us down into 129.88. So perfect delivery of sweep 20 pips, and there's like 1 or 2 more candles in here, but it's so close to where it's at. This is all I wanted to show. But beautiful delivery of price on Friday for cable. Again, I'm looking for a continuation lower on it. Moving on into a 15-minute time frame, you can really appreciate the breaker on the 15-minute time frame. You may not have looked at that as a breaker, but that's what we're teaching here today. The low, we trade right back up into it, and beautiful, beautiful sell day profile for equal highs. We raid through it, go about 20 pips above that, creates the high today. London open, and into a fair value gap, consequent encroachment, and bearish breaker. Beautiful. If this would have been any other day but non-farm payroll, I would have been all over that right there, and you would have seen one more example on Twitter for our Instagram model. And we have equal lows here. That would be a first target. We trade back up into that. This becomes a breaker as well. Distribution heavily running Monday and Tuesday's lows. Liquidity pool hammers it beautifully. So really, really nice price action on GBP on Friday. Moving on into our what's ahead. So looking ahead for this month, we have, technically speaking, we have a teaching segment on April 12th. I'll be talking about the contrast between long and short form analysis. And on April 19th, for charter members, you will have price action model number 3 amplified lesson. And then for the April 26th teaching, this is only for 2017 charter members, price action model 11. And that's it going for the close for this week's review and looking ahead. I'm going to give you a lesson now on overlays. All right, folks, it's a quick overlay lesson and how to measure institutional accumulation and distribution. There is obviously the levels we looked at here from the higher time frame, as mentioned in an earlier portion of this week's video. So again, if you don't know what these blue areas are, just go back and watch the video as it pertains to the dollar index, and you'll see what these blue levels are. But once price trades into these levels, are they going to be important? How can we see professional accumulation and distribution in price action without having a reliance on indicators or math-based derivatives of what has already happened in price? We're going to be looking at the real measurements of accumulation distribution relative to the areas that's been shaded here. You're going to go to your Customs tab, and you're going to select Overlay Chart. Now, Overlay Chart, the link for this particular indicator is going to be posted at the bottom of this forum post, so you guys can have that. Once you click on Overlay, you're going to do the overlay on the dollar index chart only. Okay, so it's going to make it a lot easier for me to teach it to you, and it just makes it simple. Once you open it up, it'll give you this box here. You can double click on this area where it says symbol, and it has to be capitalized, all capital letters. We're going to be doing GBP USD. Okay, and the color here, I just like to have a deep maroon color, and for the grid, I like to take the grid off. Just double click on it and it'll give you this drop down. Then I click no, none. Okay, so if you want to have a grid on there, it just makes the chart very, very busy, and it just, to me, it's not as clean and crisp. It doesn't jump off when there's a significant divergence between the dollar and the pair. Now I'm going to show you the two perspectives to use with this. Now you're going to have to determine which one you feel comfortable with. I already know which one you're probably going to elect to go with, but still it will promote confusion if you're not organized. If you don't keep track of what you're doing, you're going to look at something and assume there's a divergence when there really isn't. Okay, so for now, for the first example, the mirroring, and I'll explain what that is in a second, leave it to setting of false. Then click OK. And now all of a sudden it'll populate your chart with the GBP price action on a line closing basis. So every day we see on this chart for the section of price action, all of this price action, well, not this, but right in here, this is all GBP USD price action. Okay, as it is if you were to look at a chart and change your chart from candlestick to line chart only, that would be seen on GBP on a 15-minute basis. And to prove that, we'll drop over to the 15-minute time frame and we'll change the chart to a line, and that's exactly what you're seeing here. Okay, so all this is doing is overlaying this perspective on GBP overlaying it right on top of the dollar index chart. Now, what makes that useful is when price trades up into an area where we anticipate institutional order flow to be a factor, okay, then I want to see if there is a divergence. Now, I can see a divergence in here, but you may not see it. And it is in the form of the higher dollar index, and there was no attempt to go lower on the GBP pair. It just went higher. That in itself signals there is a real measure of accumulation in British pound. So in other words, British pound should go higher. If that doesn't make sense to you, I'm going to show you how you can get a better perspective on it by simply going and clicking right on your mouse, the right button on your mouse, go to indicator list, click on that, and up on overlay chart, highlight it, and then click the edit tab. And this is probably going to be the setting most of you are going to go with because it's going to make more sense to you because you're comparing both markets or pairs or dollar index against a specific currency pair in the same light, like you would look for a standard divergence in an indicator versus price. This is going to give you the similar perspective as that. And all I did was removed the false setting and made it to true. Now it's mirrored. So everything here on the line basis is GBP versus dollar. Still, it's just inverted. So now you can look at the relationships of the British pound versus the dollar index. They are not like presented this way, obviously. Okay, whatever the dollar's doing, GBP should be doing the opposite of. But if you ever invert the price chart of GBP USD versus the dollar index, you're going to get this perspective here, and it jumps off the chart a lot easier for a new trader that doesn't understand correlation. Dollar index, which is the candlestick portion of this chart or overlay, this is a higher high. So we see that the dollar index is in fact making higher highs. But at the same time, British pound is not making higher highs when the price is inverted. So this, when the chart is inverted, okay, or when mirroring is true, and I'll show you what that looks like again so it doesn't confuse you. You're going to need to watch this video a couple times already, I can tell. Click on edit, and the mirroring is true. So what that is, we're mirroring the delivery of price action on GBP versus US dollar. It's inverted. Whereas if we had it set to false, like it default setting is, it's going to show it as we see normally when price is being delivered, like that. But if we invert this, it's going to look like this. Okay? So now, the benefits of having it like this, you can see the contrast between the two markets. For instance, clearly there's a heavy accumulation in British pound here. Why? Because dollar pressed up into an area where we'd expect to see some measure of resistance, okay, or distribution, while the British pound on this particular day was showing an unwillingness to go lower. That's what this is doing. It's showing us it's moving higher because it's inverted. Now, and that probably confused you, but if we go back over here and look at the April 2nd price action, here's April 2nd. It's going lower, 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 and it's not going lower here, whereas the dollar index on the 2nd, watch what happens if we go over here, 15-minute time frame, put it on a line basis, put our daily dividers in here, Friday, Thursday, Wednesday, Tuesday. You see price making a higher high here on the dollar index, while at the same time, cable is unwilling to go lower. So that is a USDX SMT divergence. Okay, you can see it like that. What helps is when you have it on your overlay like this, it may not be so clear to you like this, but I've been doing this for 20 years, and it's just very easy for me to know what it looks like. The key, which makes SMT divergence or correlation cracks, okay, so obvious in terms of measuring institutional accumulation and distribution, is that we're measuring price against another correlated or inversely correlated asset versus dollar index and the GBP. So if we're doing that, this may look bullish at the time when it starts pressing higher, but we've already had an idea that this thing was going to be an area where it's going to be impactful for price action. So if price goes up into this area, at the same time, SMT or correlated analysis or market correlation indicates there is a crack in correlation. So because this higher high in dollars should have been met with a equally lower low in GBP. It has not happened. It did not happen, and it was not showing in price action. So this is a bearish scenario for dollar, and this is a run on stops right here. And once it breaks down, this becomes a breaker. So now you can anticipate at this price point here for dollar, it supports a stronger cable. So if you weren't able to see it at the time, on this candle here, when it's trading up into the breaker again, let me get on the right candle here, on 1745, on the 2nd of April, 1745, at that moment, we go back over here to candles, on the 2nd, and let's go in here, here's 14, 16, 18, 17, and then right in here should be this candle. 1745. At that moment right there, it is a bullish scenario if you're waiting for a breakdown in the market structure for USDX, but it's already moved a lot. So by measuring, and you can still catch a bullish overbought in here, and then it rallies up a little bit more. But going back to the dollar index, you can see the effects of understanding these areas where institutional order flow is going to be impactful. Okay, fair value gaps and such, volume imbalances, consequent encroachments, all those things are like billboards. Like, hello, pay attention to this area in price action. Once price trades to these levels, then we have to look at it from an X-ray view perspective. Is there real accumulation going on or distribution going on? And there's a huge amount of accumulation for GBP here. Now I'm going to reverse this. I'm going to take this portion off here. And I'm going to invert the chart again for the GBP USD overlay. And now you can see, while it was making higher highs here, it was not making a lower low, and that's what's showing here. Okay, so a lower low was not being posted in the cable, while higher highs have been posting on the dollar. That's a crack in correlation or SMT divergence, and because it's coupled with the dollar index, it's a USDX SMT divergence. Okay, there is another one in here. Now I'm going to take this and invert it back to showing the mirror. So we're going to click true, so that way you can see it directly relating to the price action on the dollar index. We see a low form here on the dollar index and then a higher low form on the dollar index. But notice what's happening here on the cable. GBP makes a low, yes, and then it went lower here. So there's strength in the dollar versus the weaker, lower low on cable. So that in itself is signaling that there's strength in dollar, weakness on GBP. We can see the divergence in here with lower lows in cable, higher low, relatively speaking, on dollar. So that's strength for dollar because it's failing to see a equally lower low if we have the overlay inverted or the setting set to true for mirroring. So if it's mirroring or it's an opposite depiction of normal delivery of price action for GBP, the accumulation seen here with this lower low in cable, but that same comparable low is not seen being made lower for dollar index, and those two reference points would be here. Here's cable, lower, and then here is dollar index. And I'll contrast those two colors so you can see the difference in it. Okay, and I'll take the line dividers off. So this low to this low is dollar, higher. Cable, this low to this low is lower. So once we traded into this, we came back, traded into an order block, traded back down into an order block, we can see real accumulation from an institutional perspective that dollar should go higher. Price does in fact trade higher. And on the 4th, cable, Judas swing, runs, stops. This is all fake. And then price falls out of bed and trades lower. So if we want to look at this, once it's loaded up on a chart like this, you can keep one of your charts open on your platform. Okay, so now we have the euro-dollar overlaid, and I'll get these two annotations off the chart because they're salient to cable, not euro. And again, just to double check before I start jawboning, the setting is set to true on mirroring. So everything we see in euro is reversed. So the overlay is shown here. So this is actually a movement going higher on the 2nd. So April 2nd, all of this movement here going lower on euro is actually a movement higher on the 2nd. You can see that here. Okay, all of this movement here relates to that. But you can see the heavy distribution that takes place relative to the movement higher in dollar index. We are not seeing that same measure of lower lows forming on euro dollar in a comparable sense. So this is a cracking correlation or heavy distribution, okay, is expected for dollar index or selling off, in other words, bearish, and this is bullish for euro dollar on the 2nd. So on the 2nd, we would anticipate some bullishness form, and we see that here. Price breaks market structure here, comes back, bullish order block, fair value gap in here as well, filled institutional order flow, entry drill, bam, late New York entry. Asia here, rolls on through, trades up into an area of liquidity, which we mentioned earlier in the portion of this video. So you can see there's a definite strength to understanding accumulation and distribution. Reasons for specific swings in price are going to not be rooted on just the divergence between the euro or cable or even the New Zealand dollar or the Aussie dollar. You would just put your pair name in instead of where we have GBP USD or Euro USD in these examples here. You would just simply put your dollar-based pair there and do the overlays as we've outlined here. Another divergence is seen here with this low to this low, right in here. Again, after we've traded at an area where we saw real accumulation occur on dollar, bullish order block, rallied again. Now we're starting to see a lower low form in dollar, but this line-based chart is euro. So that's actually failing to make a higher high here. When this was going lower, euro dollar was actually failing to make a higher high. So that's bearish on euro dollar. So this movement up is bearishness. On the 4th, and here is the 4th here, and that's that bearish move right there. Okay, so we can measure where it would otherwise be looked at as retail would see something like this. They would say, okay, well, this is one of those classic ascending triangles, and they're going to look for a breakout on the upside. But we're looking at prices with an internal perspective or X-ray view institutionally, and we can actually see what the banks are actually doing, and they cannot hide it. They cannot hide this. There's no reason to worry about it. You shouldn't be teaching this. Everybody's going to use it. No, it's because their volume is so large and they have to operate like this. There's going to be cracks in correlation. The neophytes and the people that don't understand correlation, they will say and dismiss it. Well, sometimes it works and sometimes it doesn't. Right. That's the benefit of knowing how I teach it. Because when it does exist and the context and narrative is understood with supporting institutional perspective and an order flow, then we have a real diametrically opposed wrestling match between retail perspective, and it is hedge fund level as well, and institutional level. And they're all going to look at this stuff as continuation classic chart patterns, ascending triangles or ascending wedges, and hoping to be ledges. And they get sliced and diced, and it's a movement against them, and they reprice down into an imbalance. Okay, so hopefully this has been helpful to you, and until I talk to you next week, I wish you good luck with trading.